there's a financial secret that almost nobody talks about in the viral personal finance world. It doesn't make flashy headlines. It doesn't promise instant riches. But it works quietly, relentlessly, and with the kind of power that transforms ordinary savings into extraordinary wealth. The secret? Compounding. Just $10 a day can grow into $1 million, given the right time, patience, and strategy. Today, we're going to break down the real math behind compounding and learn how you can use it to turn a tiny daily habit into a lifetime of financial freedom. Most people underestimate time and consistency. They think building wealth requires huge sums, stock-picking genius, or risky bets. That's a lie the media loves to sell. The truth is far simpler. Compounding doesn't care about how much you start with. It cares about time, rate of return, and consistency. Every dollar you invest has the potential to grow, and as that growth itself grows, it begins to snowball. This is why the same $10 a day, when invested wisely, becomes unimaginably more than $3,650 a year. It becomes a money-making machine that works while you sleep. Step 1 in understanding this magic is grasping the exponential nature of compounding. If you invest $10 a day, that's $300 a month, and you earn a modest 10% annual return, your first year is straightforward. Around $3,650 invested grows to about $4,000 by year end. Not life-changing yet, but here's where the math turns into magic. In year 2, your 10% return doesn't just apply to your new $3,650 deposit, it applies to last year's growth too. And the year after that, the growth applies to all previous growth plus contributions. By the time you reach 20 or 30 years, that $10 a day isn't just $36,500 in contributions, it's hundreds of thousands of dollars, and in some scenarios, more than $1 million. Compounding is patient. The first decade of investing feels slow. You watch the contributions pile up, and it's easy to doubt it'll ever matter. But then, somewhere around year 20 or 25, something incredible happens. Your gains start earning gains at a rate that dwarfs your contributions. That's why starting early is non-negotiable. If you start at 25, $10 a day compounded at 10% annual return can surpass $1 million by your mid-50s. Wait, 10 years to start? And suddenly you're not looking at $1 million anymore, more like $500 to $6. Oh, okay. That's the cost of waiting. Lost time is lost exponential growth. Step 2 is understanding the power of consistent contributions. $10 a day seems trivial. You spend more on coffee, streaming services, or takeout without blinking. But the discipline to commit every single day turns into a snowball. If you automate this, the process becomes effortless. Your bank or brokerage account withdraws $10 daily, invests it, and begins compounding. You don't need to time the market. You don't need to pick the next big stock. You simply feed the compounding engine consistently. And over decades, it transforms small sacrifices into extraordinary wealth. Next, let's tackle the realistic rate of return. The stock market historically averages around 10% annually over the long term, including dividends and growth. That's not a guarantee, but it's a reasonable expectation for someone investing in diversified index funds, ETFs, or a balanced portfolio. Some years will be higher, some will be lower. Recessions will shake your portfolio. Corrections will make you nervous. But compounding doesn't require perfection. It only requires continuity in time. Miss 1 year, life goes on. Stop contributing for 5 years? It hurts, but the process can resume and still generate wealth. Step 4 is embracing the psychological edge of compounding. Humans are wired for immediate gratification. We check daily stock movements, crypto prices, or trending assets, thinking wealth is made in a day. Compounding laughs at this mindset. It rewards patience, discipline, and boredom. The moment you stop worrying about short-term gains and focus on long-term growth, the math starts working for you. Step 5 is understanding tax efficiency. Compounding is a cruel master if the government takes too much of your gains every year. That's why tax-advantaged accounts like IRAs, 401(k)s, Roth accounts, or tax-efficient investment vehicles matter. They allow your compounding engine to operate uninterrupted, maximizing exponential growth. Another layer to consider is inflation itself. $1 today won't buy what it does in 30 years. That's why $1 million in nominal terms isn't the same as $1 million in real terms. Compounding at rates higher than inflation is the only way to truly secure wealth. Step 7 is the role of reinvestment. Dividends, interest, and capital gains must stay in the system. Every dollar that leaves interrupts the exponential chain. Professional investors rarely take profits out early unless strategically necessary. Reinvestment accelerates compounding, and the longer it stays, the stronger the snowball. Even modest reinvestments dramatically change long-term outcomes. $10 a day with dividends reinvested grows faster than $10 a day without. The final step is embracing discipline over emotion. Markets will crash. Portfolios will drop 20%, 30%, or even 50%. Beginners panic, they sell, they quit. But compounding thrives on staying in, even through storms. The genius of $10 a day isn't just the math, it's your commitment to keep feeding the system regardless of daily chaos. Every dip is an opportunity, every crash a compounding catalyst. Time is your ally if you refuse to abandon it. Now imagine a world where you start this system in your 20s. You spend $10 a day less on coffee, snacks, or impulse purchases, and redirect that toward a diversified, compounding investment. By your mid-50s, you could be sitting on over $1 million, not from luck, but from small, consistent action compounded over time. Even if you start later, the same principles work. You just may need to increase contributions or accept a slightly longer horizon. The point is this: small daily habits, powered by time and growth, can yield results that seem impossible to anyone thinking short-term. Here's the truth that few admit: $10 a day is enough. Not because it's magically a lot of money, but because compounding amplifies small contributions into enormous outcomes. The math is simple, brutal, and relentless. You don't need to time the market, pick winners, or take extreme risks. You need discipline, a realistic return expectation, and the patience to let the numbers do their work. And that's the real advantage that separates long-term wealth builders from everyone else. So here's your blueprint. Commit $10 daily. Invest it in diversified assets capable of delivering 7 to 10% annual returns. Reinvest every dividend and capital gain. Start as early as possible. Ignore the daily noise. Embrace volatility as an ally. And above all, respect time, because time is the rocket fuel for compounding. Over decades, what seems trivial, $10, becomes monumental. What seems impossible, $1 million from pennies a day, becomes reality. If this video changed the way you think about small habits, compounding, and long-term wealth, hit like, subscribe, and comment below. Would you prefer a visual breakdown showing how $10, $20, or $50 a day compounds over 10, 20, 30 years? Or a full guide on how to structure your investments for maximum compounding efficiency? Take action today. Start small, start now, and watch the math quietly turn your daily $10 into a life-changing fortune.